So everyone always talks about ETFs, but nobody really says what the heck an ETF actually is so that we can understand it. In this video, I'll be going over what an ETF is and why it matters to you as an investor. It's absolutely the most simple way to invest and takes all the guesswork out of it so that you can focus on what matters in your life. And I doubt that has anything to do with the stock market or reading charts or finance reports all day. I'll also clear up some common questions like what is the difference between an ETF and an index fund and which one is better. By the end of this video, you'll be well informed so you can become a better investor, and that's my goal here on this channel. So if you don't know exactly what an ETF is, don't worry, you're probably in the majority, but after this video, you are going to be an expert. Here are some basics so that you can understand. ETF is an exchange-traded fund, and it's basically like an index fund, but traded like a stock. For now, for all intents and purposes, ETF, index fund, synonymous, basically the exact same thing. So when you invest in a stock, say that stock is $50, and then you own one stock of that one company, so now you own $50 in that company. 100% of your portfolio is invested in that company, so 100% of that $50 is that stock. An ETF holds multiple stocks in one basket. The ETF itself is going to cost a certain amount, just like one stock of a certain company is going to cost a certain amount. So let's look at QQQ, which is one of the best growth and technology ETFs out there. QQQ has a price today of $530.70. QQQ has 100 companies within the ETF. So if you buy one share of QQQ, you now own a small piece of 100 companies. When we look at the fun facts on Invesco QQQ's actual website, you can see that we have 101 actual holdings within QQQ at this point. When we look at their top 10 holdings within the ETF, it's got Microsoft at 8.65%, Nvidia at 8.56%, Apple at 7.58%, Amazon at 5.6%, Broadcom at 4.74%, and then the next 5 in the top 10 are Meta, Netflix, Costco, Tesla, and Alphabet or Google. The top 10 holdings in this are 50% of the entire fund. So even though there's over 100 companies, the top 10 take up half of this fund. So to put it all together, since you own one share of QQQ, which is $530.70, when you actually break down what's inside of that share, you just multiply the percentage of the holding by however much the ETF is worth. So as far as those top 3, in Microsoft, since it's 8.65%, you actually own $45.85 in Microsoft. In Nvidia, you own $45.43. In Apple, you own $40.28. To figure out the rest of it, you would just do the math this exact same way. There are so many types of ETFs out there, like totally broad market type ETFs that cover the entire US stock market, or it could be the entire international stock market. There's also ETFs that have very, very niche type sectors like technology or healthcare. And then there's specifically growth type funds or dividend investing funds. Everybody's portfolio might be a little bit different, and that's totally okay. It's probably not your best move to just copy somebody's portfolio just because for them it's working out. And you'll see why by the end. So once you start getting into investing and you start listening to people talk about investing or reading about investing, you're gonna see these two different categories, something called an ETF and then something called an index fund. You probably also see things called mutual funds and individual stocks and all these other things, but the things that are the closest are the idea of the ETF versus the index fund. The biggest difference between ETFs and index funds is that ETFs can be traded throughout the day like stocks, whereas index funds can be bought and sold only for the price set at the end of the trading day. For long-term investors, which most of you probably are, and I know I am, this does not really matter. Buying or selling at 10 a.m. versus noon is not really going to change the difference, especially 10 years from now. The couple pennies that you save or that you gain today don't really matter compared to the dollars or hundreds of dollars or thousands of dollars down the road. If you're interested in intraday trading, ETFs may better suit your needs. They can be traded like stocks, yet investors can still reap the benefits of diversification. ETFs may also have lower minimum investments and be more tax efficient than most index funds. Despite their differences, index funds and ETFs do have a lot in common, including diversification, low cost to invest, and strong long-term returns. One big thing that you're going to hear about a lot has to do with this idea of capital gains tax. ETFs are more tax efficient than index funds by nature thanks to the way they're structured. When you sell an ETF, you're typically selling it to another investor who's buying it, and the cash is coming directly from them. Capital gains taxes on that sale are yours and yours alone to pay. To get cash out of an index fund, you technically must redeem it from the fund manager, who will then have to sell securities to generate the cash to pay you. When this sale is for a gain, the net gains are passed on to every investor with shares in the fund, meaning you could owe capital gains taxes without ever selling a single share. This happens less frequently with index funds versus actively managed mutual funds, but from a tax perspective, ETFs definitely have the upper hand over an index fund. All of that was very deep and in the weeds, and for most of you, you're probably not going to notice the difference between the two. The big difference between the two is that ETFs are definitely going to be more manageable as far as being able to afford buying one share. For example, one of the most popular index funds out there is called the S&P 500, or the Standard & Poor's Index. And the S&P 500 right now is a little over 6,000. But then there's an ETF called VOO, V-O-O, that actually tracks the S&P 500. And for this, it costs a little over $551 to own one share. It's the exact same thing with almost identical returns because that ETF VOO tracks the S&P 500. So whatever the index fund does, the S&P 500, VOO is going to move at the same exact pace. But to buy in at one share of owning VOO, you get to pay 10 times less. Neither is better than the other, because at the end of the day, the way that you look at your investments is total money invested, not in how many shares or of what specifically. For example, if you were to buy one share of VOO, you'd have a little over $550 invested in the S&P 500. Then if you were to buy two shares of VOO, that would basically be $1,100 invested in the S&P 500. If you were to buy one share of the S&P 500 index fund, you'd basically say it like, I have $6,000 invested in the S&P 500. So it's about total money invested within the actual fund, not really how you get it there. The other thing is the ease with which how you can actually buy this asset. On some platforms, you can't really buy the index fund itself, but on most platforms, you can buy ETFs that track the asset. There's multiple types of ETFs and companies that own these ETFs that can track the same underlying index. So for example, VOO is one version that tracks the S&P 500. Another version of an ETF that tracks the S&P 500 is SPY, S-P-Y. And there's multiple ones out there.